Hello, everyone, and welcome to the weekly market update from ICM.com. I hope you're all safe and enjoying the current market movements. So, we are going to start as usual by the coronavirus updates. Also, we added this week another small topic which is affecting the market heavily, the latest developments between China and the United States, their tensions, and then we're going to highlight the key economic events and releases for the coming week, and then go over some of the major charts on the MetaTrader 4 platform. So first, starting with the COVID-19, the total confirmed cases crossed 16.2 million, almost 1.7 million from a week prior. So this is a rapid increase in confirmed cases. The recovered cases surpassed 9.4 million, which is also significant. So we have also around 1.3 million in recovery cases for the past week, while casualties or deaths are almost near 650,000. The pace of new cases in the United States is slowing down, especially yesterday and over the weekend. It is a bit down after total cases crossed above 4.2 million in the US alone. Texas reported smallest increase in 2 weeks. California also reported cases are less than 14-day average. The new cases in Florida dropped from peak, and Arizona new cases rose by 1.2% only versus the daily increase average of 1.8%. So also some optimistic news from the United States relative to related to the confirmed cases. And now India's pandemic is the fastest growing, around 20% increase since the last week. So it's becoming the hotspot. Uh, Also, European currencies are trying, current countries are trying their best to avoid having a second wave, especially after the latest outbreak in Bavaria and Germany. So they are trying their best to avoid having a second wave, since it's gonna have a significant impact on the economy. So governments are trying to not go through this. In Australia, Victoria, the authorities are struggling to control the second wave of infections for almost a week now. In Hong Kong, they are banning all the dine-in services at restaurants and requiring people to wear masks outdoors and limiting the public gatherings to 2 people after registering 100 cases for every day for the past 5 straight days. So this is also a serious development in Hong Kong. Today, Moderna, on the bright side, a little bit of a bright side, Moderna and the National Institutes of Health are starting the biggest study with 30,000 volunteers. So if this study succeeds, then we possibly have a vaccine. So let's always hope for good. Moving to the financial side of COVID-19, the U.S. lawmakers are discussing the next round of stimulus. Republicans will release their 1 trillion coronavirus relief plan today, as per Stephen Mnuchin. Last week, it was supposed to be released last week, but it was delayed till early this week. So yesterday, the Treasury Secretary Stephen Mnuchin said that the Republicans are ready to propose their relief plan. So market participants, investors are waiting for this to happen. Moving to our next topic, this is all what you need to know about the COVID developments. Apparently, governments are not willing to go for a strict lockdown that could hurt the economic recovery. So they're trying to have the least impact on the economy while also trying to control the spread as much as they can. So this is for COVID-19. Moving to our next topic, which was weighing a little bit on the market. It's not very accurate yet, the impact on the market, but still it's one of the key topics to watch out for. The US-China tensions, as we know, both countries ordered the closure of consulates last week. The US accused China of espionage and intellectual property theft, ordering it to close its consulate in Houston, while China responded by ordering the closure of Chengdu consulate. So 1 for 1. That's what happened last week. Mike Pompeo, also the U.S. Treasury Secretary, U.S. Secretary of State, while he was ordering the closure of the consulate, he also offended or described the Chinese president as Xi as a true believer in totalitarian ideology, which was also considered one of the retaliations, or one of that it's his actions are considered as if the United States is taking this a step forward. Well, also Trump declared that they reached phase 1 trade deal it means much more less for him currently. So it looks like the Trump administration is pushing forward with the clashes ahead of elections. Further escalations in tensions maybe could weigh on the risk appetite and lead the demand for safer assets. We've been seeing a strong rally in gold prices, and maybe this is one of the key supporters for the recent rally in fuel, which is the recent rally in gold, which is definitely the growing tensions between China and the United States. Now let's move forward to highlight the top economic events for the week. Tomorrow it's a bit shy with only the consumer board, the conference board consumer confidence from the United States in focus. Is expectation of a slight drop towards 94.5 from 98.1 previously, and also we have the American Petroleum Institute weekly crude oil stock at expectation of a slight drop after posting a buildup of 7.544 million barrels last week. Moving to Wednesday, we start early with the inflation figures from Australia. The consumer price index is expected to drop by 2%, to have dropped by 2% quarter on quarter. So this is from Australia. It could have a little bit of an impact on the market. Maybe this could trigger the Reserve Bank of Australia to take additional steps, maybe to lower interest rates from 0.25 to 0.1. So maybe this will also depend on the impact or on the magnitude of the drop in CPI during the second quarter of 2020. Moving to the United States, we have the pending home sales for June, expectations of a rise by 15.3% versus 44.3% back in May. The crude oil inventories, the weekly oil report by U.S. Energy Information Administration, expectations of a plunge by 2.088 million barrels versus a buildup last week by 4.892, which affected the market. We've seen oil prices rebounding from their highest level since March. So this was an impact of the rising or the buildup in crude oil inventories in the United States, which also signaled that the demand could be easing or dropping. Also, one of the key events, or among the key events of the week, is the Federal Reserve interest rate decision of the Federal Open Market Committee meeting. The Fed will kick off the meeting tomorrow. It is a two-day meeting. They will publish the decision on Wednesday. So there are no expectations for a change. Interest rates are to stay at their lowest levels between 0 and 0.25% brackets. However, the Federal Reserve will be should be giving hints on what are his considerations of the latest COVID-19 developments. Is the Federal Reserve ready for further deterioration, maybe in the economic outlook? So this is all should be monitored closely. Any signals on the future path of interest rates or future path of policy in general could have an impact on the market. Interest rates aren't expected to be adjusted mainly to the upside and in the coming 2 years at least. So this is what the market is currently pricing. So any talk about tightening the monetary policy could have an impact on the market. So this is for the Fed. Also, it will be followed by a presser by Jerome Powell. So he will be communicating the decision to the public. On Thursday, we start with the German unemployment change, a rise by 45,000 is expected. The first reading of the second quarter GDP, also one of the important releases this week, is the preliminary reading of the second quarter GDP. We have from Germany, from the United States, and from the Eurozone. So from Germany, there are expectations of a contraction by 9% during the second quarter. Also, we have the Eurozone unemployment rate expected to rise to 7.7% from 7.4%. And the German consumer price index month-on-month expectations of a drop by 0.2%. One of the key releases, the United States, the preliminary reading of the second quarter GDP from the United States is very important reading and could have really good impact on the market. So you better watch out for any trades during that day if you are holding any open positions ahead of the release. So you better watch out for this release. Expectations of a contraction by 34%. So this is a very big number due to, of course, the lockdown that occurred during the second quarter. So this is what you have to watch out for from the United States. Also, the GDP price index quarter on quarter for the second quarter, expectations of a rise by 1.2% versus 1.6 previous. And we end the day with the initial jobless claims, the weekly initial jobless claims, which are expected to come at 1.4 million versus 1.416 previously. Moving to Friday, also we start early with the calendar is a bit packed, so we start early with the manufacturing and non-manufacturing PMI from China. Nothing crucial expected. A little bit of a change, a drop in manufacturing PMI to 50.7 from 50.9, and the non-manufacturing PMI is expected to tick higher towards 54.5 versus for 54.4 previously. Moving to the Eurozone, or to Europe, we have the German retail sales expectations of a contraction by 3.3% after a sharp surge of 13.9% in May. Also from the Eurozone, we have the consumer price index year on year. Year on year, we expect a rise by 0.2%, and also the preliminary reading of the second quarter GDP expectations of a contraction of 11.2%. So much less than the impact in the United States. So these are the key figures to watch out for this week. Also, we have on Friday the US PCE price index, or the core PCE price index, very important month on month. It's one of the best gauges for the Federal Reserve to watch out for inflation. So it's expected to rise by 0.2% in June. The personal spending in June also expected to have tick higher to 5.5%. Also, we have the GDP from Canada, the month on month change. In May, the economy is expected to have grew by 3.5% versus a contraction of 11.6% in April. And also moving to the United States again, we have the Chicago PMI expectations of a rebound in July to 44.5 versus 36.6. The revised Michigan consumer sentiment a slight tick lower towards 72.9 from 73.2, and we end the week with the US Baker Hughes oil recount, which rose to 181 last week, the first rise since March, since the oil prices dropped sharply. So this is one of the good changes in production in the United States. So we've seen a rise in oil rig count by for the first time in almost 4 months. So these are all the economic events for the week. So to recap the top economic events, we have the Federal Reserve monetary policy meeting on decision on Wednesday. On Thursday, the preliminary reading of the second quarter GDP from Germany and the United States, and on Friday also the GDP reading for the second quarter from the Eurozone and the May GDP from Canada. So these are the key important events for this week. Now moving to the MetaTrader 4 to talk about some of the key financial instruments. We've seen a sharp rally in most of the major currencies against the dollar. The dollar was the weakest across the board, especially as the coronavirus continued to spread in the United States, triggering concerns or raising concerns over the economic recovery in the United States. So there are a little bit of concerns currently that the US won't be having a V-shaped recovery. So this impacted the dollar, and also the further or the growing bets over further fiscal and monetary policy, fiscal and monetary stimulus also affected the dollar strength. So let's start with the euro dollar. The euro is rising towards its highest level since almost September 2018. Of course, the relief package applied or agreed by the EU leaders last week boosted the sentiment in the region and boosted the money flow towards the region. So now it is more attractive than other top countries or top economies. So this is what's supporting the euro dollar. We're seeing the euro dollar currently trading near 17.56, the highest since September. If we have just a look on the charts to detect some of the tops, we could find some resistance near 18.45, and after that the previous top near 20.76. So we're just going to highlight them now. So these are the two key levels if you are long on the euro and awaiting some key resistance areas to get out, or if you are looking to short the euro, maybe we could have some a little bit of a correction near 1840 and 2060. Currently, the RSI on the weekly chart, it is approaching the 70, and the bands are a bit wide, but there are no current signs of a reversal. If we go for the daily charts, also similar, we have a series of consecutive days to the upside. The RSI is clouding above 83, and the bands are so wide, and the price diverged a lot from the 100 and 200-day exponential moving average, but still we don't have any sign for a reversal in the euro dollar. So this is for for the euro dollar. We highlighted the key the key levels. I'm gonna just highlight them again on the daily chart. So these are the key levels. If we're gonna look for some levels, maybe to if some traders are looking to join the trend, you have to look for some retracements back. So let's just draw the Fibonacci. Let's put the Fibonacci retracement and try to have some key levels. So maybe some traders would be looking to join the trend when we have a bigger correction towards 38.2, which could coincide with the previous stop. So near 1530 level, this could be one of the key areas, and another area near also the recent top near 114. So these are the key areas if you are looking to join the euro trend, maybe after a correction. So these are the two key levels if you are trading. So almost here and here, these are the key levels that you could be looking for if you are waiting to join the trend. So these are the key levels for the euro dollar. From the upside 1840 and 2096, and from the downside 1533 and 1416. This is all for the euro dollar. Moving to the pound, also a good performance from the pound. We can see, I'm just going to remove these indicators. So here we can see that the pound is rising towards its highest level since March, since the drop, the sharp drop that took place following the outbreak. So what to expect if this rally is expected to continue? We have to wait for a little bit of a resistance, or expect some resistance near the previous stop. First, we have the psychological level near 130, and then 130, 130.60. So this area between 130 and 130.50 could be filled with orders. And again, the 132.20 level, which was the resistance in January and in late February, early March. So this is on the upside, and on the downside, if you're looking for a retracement to join. So let's just apply the Fibonacci here. So maybe you should have to wait for a 38.2 retracement near 2640, and so around 2640, which could coincide with these previous stops, and maybe further towards 2478. So these are the key retracement levels if you are looking to maybe join the trend, but they are a little bit far away. There's a closer one which could that was the resistance and could be turned into support near 28 level, 2770. So this could act as a minor support. Let's highlight it on the hourly chart, which could have more clarifications. So this is on the hourly chart. We can see that we have a series of higher highs and higher lows. The RSI is near 70, and the price is still above the 100 and 200 hour exponential moving average. We don't have any clear signs of a reversal yet, so watch out for any break of this trend line. So this could have could have a little bit of a sharp movement on the market. So watch out for any rebound here towards 2770 area that we just talked about, that was currently here, the resistance level. So these are the levels on smaller time frames, 2765, 2770. So this could be another demand area if we have a smaller correction lower. So this is for the pound. Let's move to the dollar yen, which is moving finally after being stuck inside the consolidation zone for the past almost 3 months. We've been always talking about this area here, and finally the price managed to break lower since the dollar is losing its status as a safe haven, and the yen is gaining on this. So we're seeing a drop in yen. So if you are looking for some targets on the downside, we just have to go for the Fibonacci extension. So currently we are trading near the 123.6 level. So further extension could drive the prices lower towards 103.70 almost, which is 161.8 retracement. So this is one of the key resistance levels to watch out for. and again the 102.80, 102.70. So these are the key levels to watch out for if you are expecting a further drop in the dollar yen. Here we are currently trading at the 123.6, which could offer some support to the price. And on the upside, we have a resistance near 105, 106 level, 105.95, 106, and then after that near 107 level, 106.95. So these are the levels if you are trading the dollar yen. Let's go for a smaller time frame. If you can see here, the price the price is moving down sharply. We have a steep slope in the dollar yen. We have here also we had this support zone near 1662. So on the smaller time frames, watch out for this level as resistance. So we have almost 106, 1660, and 107. These could play. These could offer some resistance if the price is gonna, or the pair is gonna rebound a little bit to continue back lower. So watch out for these levels. There is nothing much to talk about on the dollar yen. It's clear that since the 23rd of July, we were witnessing a sharp move lower in the dollar yen, and we're seeing how the price is acting or reacting to the 20 simple moving average, the 20-hour simple moving average. So every rebound to the 20-hour simple moving average is being sold, and the price is sticking to the lower band. We are using the 20 period at the Bollinger Band. So this is for the dollar yen. Let's move to the USD CAD, which was also moving a little bit. We have here almost a slight consolidation zone near 133.45 area. We've highlighted this area before since it was around the closing levels of the previous period. So let's just start with the bigger time frames. So this is what we've talked about lately. We had this resistance level here, the key resistance. We had a similar or a little bit off. It's not very accurate, but around a complex head and shoulder formation, and the price moved lower. So almost we have the full target here. So if you are looking for some targets down, we have the previous low near 133 level, and then also the lowest level in almost February, which was around 132. So these are the key levels if you are looking for targets, if you are short and looking for targets, and if you are looking for a pullback or a break of this downtrend, you have to wait for any break above 134.80, the neckline, or 135 levels. So this could be could drive the prices higher. Also, we have this trend line here, which is almost combining all the tops we're currently trading at. So it is coinciding with the neckline. It's almost 134.80, could provide some resistance to the price, and on the upside we have 136.40. So these are the key levels if you are trading the USD against the CAD. On the downside, 133.15 and 132, and on the upside 134.80 and 136.37. So these are the key levels. Let's add some indicators. You can see here that the bands are closer to each other, and then we have this little breakout here. So watch out how the price will react. We are currently near the 100 and 200 hour exponential moving average, and the bands are a bit wide, but still this doesn't mean that we have to rule any move further to the downside. On the hourly chart, we are seeing a little bit of resistance as the price is closing into the 100-hour exponential moving average. So watch out how it would react if we have another rebound here. Maybe we could have a bigger correction and then have a steeper move lower. So this is for the USD CAD. Let's move to the Australian dollar, which was also among the top performers. The Australian dollar is having a little bit of an impact due to the outbreak in Victoria. It is one of the key areas in Australia, so this could have an impact on the growth. And we awaited last week some comments from the RBA governor in this regard. So he stated that the RBA could be taking some additional moves if they believe that this outbreak is going to have an impact on the market. So this is what is keeping investors afraid of maybe joining the dollar sell-off, by buying the Australian dollar against the US dollar. So maybe this, since we have a little bit of an uncertainty on the latest outbreak in Australia and its impact on the market, if we have just to tackle it from a pure technical perspective, we have to look out for resistance near the previous high of 71.77, and again the previous high here, the previous top near almost 70 to 90. So these are the two tops that you can watch out for if you are bullish on the Australian dollar against the US dollar. And we have this support level that it was a resistance level prior, and it turned out to be a support zone currently near 70.50 and at 69.20, which held also for almost 2 weeks during June, late June. So these are the key levels if you are trading the Australian dollar against the United States dollar. On the upside 71, 70, 80 and 72, 90, and on the downside 70, 55 and 69, 10. So these are the key levels that have some look on the hourly chart. So here we can see that it's a bit of a normal move. The price is just up. We had a move up, and then we had here a reversal formation. The price is corrected towards the 200-hour extended moving average, and after that we got a bounce here. We're still trading the bands. They aren't that wide, so this could the pair have more room to move maybe to the upside. So watch out for any break below the 200-hour extended moving average. Watch out, you should watch out for any break below it, since also it is the point that we just highlighted near 70.50. We can see how the price was reacting with the 200-hour extended moving average. Every dip below the 200 moving average was bought, and the price was rebounding to the upside. So this is for the Australian dollar against the US dollar. Moving the New Zealand dollar, almost same formation for the NZD and the AUD, except that the New Zealand dollar is a little bit in a better situation than the Australian dollar. So watch out for any move higher towards 67.50 top and 67.92. So this is an area that could provide some resistance to the pair, 67.50, 67.90, and on the downside, the previous drop towards 66.10. So this also could be a good support for the pair, and then 65. So these are the key levels that you could highlight if you are using solidly the technical analysis, or you are purely relying on the price. So these are the key levels to watch out for if you are trading the New Zealand dollar against the US dollar. Moving to the hourly chart, similar formation to the AUD USD. So we had a move higher here. We had a double top with the divergence, and then the market moved lower, and currently we are retesting the previous highs. So it's very healthy move to the upside. We are having we had higher lows. Now we're just gonna look whether to we are able to post maybe higher highs and confirm the trend to the upside. So watch out for resistance near this area, and then after that the 67.50, 67.90 area. This is for the New Zealand dollar. Moving to the top instrument for the past 2 weeks for gold. So everyone is talking about gold. It's rallying to its record high. What's a little bit confusing, that some traders, since gold is currently trading at a record high, they don't know what to watch out for, which levels they should look if wait if they are waiting to initiate a sell position. So here they have to rely either on maybe some upward channels and wait for the top of the channel to be reached, or they can go for Fibonacci extensions, or they can look for psychological levels such as the 2000 levels. So let's try to go for the Fibonacci extension levels. So if you're just gonna go for the full move from 17, almost 1780, where this whole move started, from 1790 almost towards the 1945 today's high. If we wait for the 123.6 extension, we have a target of 1980. So this could be one of the targets if you are waiting for the upside. Maybe let's have the middle of this area also could be near 1966. So let's just try to add the levels. So we can have here this, it's almost the middle point between the 100 and the 123.6, which could come in near 1963 levels. So these are the top levels if you are considering further upside for gold, or if you are waiting for some technical levels to sell using the Fibonacci extension. You can go for 111.8 and definitely 111.8 is not a level, but we are looking for 123.6, which is a bit far near 1980. So if you're just going to look for a middle range, you can go for 1960. So these are the key levels, and then we have the 2000 psychological levels. So these are the key levels on the upside if you are trading gold, if you are looking maybe to sell or to exit your long positions. And on the downside, you have to watch out for today's interim support near almost 1930, and then the 76.4 retracement for this whole level near 1908. So these are the minor support zones for gold. And on the bigger assessment, maybe you should have to wait for a bigger retracement to join the trend again, maybe a 61.8 retracement, which could drive the prices back lower towards the 1850 level. So this is all for gold. Definitely, since we are trading near a record high, you can just look for Fibonacci extensions and psychological levels if you are looking for places to exit your longs, or you are looking for places to sell your position, to initiate a sell position. The RSI is clouding, so if we go for the daily chart, we can see the RSI is near 88 levels. It's a very high level, but definitely this is due to the sharp rally since 1790. So we have a series of consecutive upside days, and also the bands are very wide. And also we can see the strength of the trend since all the daily closes for the past almost 5 days, the daily closes were above the Bollinger Band. So this is also ensures that we have a strong momentum in gold. So currently we're not witnessing any levels or any signs of a reversal, especially on the daily chart. Here we are having some pullbacks, and then the market is moving higher. We can see how the market is reacting to the 20-hour exponential, to the 20-hour simple moving average used in the Bollinger Band. Every drop towards the 20-hour simple moving average is being bought, and the price is touching again the upper band, or even closing above the upper band. So this is for gold. Let's move to the Dow Jones. So the market is moving almost sideways for the past 2 weeks. We have here this top, we have a resistance near 27,050, and on the downside we have this upside trend, so which is skipping all the moves. So today we dropped almost towards this low. So we are trading near an upside or ascending triangle, but it's not very precise, especially at the beginning of this triangle. But we have this trend line, so any break below this trend line could trigger further downside towards the previous lows near 25,290 and again 24,420 on a bigger scale. And on the upside, we need to breach 27,050 in order to continue the correction towards higher levels, and maybe we could retest the 28,000 levels. So these are the key levels if you are trading the Dow Jones: 27,050 on the upside and 28,000. And on the downside, watch out for this trend line break and 25,290 and 24,420. These are the key levels for the Dow Jones. The Dow Jones is lagging the S&P and the Nasdaq. So the Nasdaq went for a record high after this sharp sell-off, and the S&P is currently trading near rose last week towards these positions, breaking the previous top of recorded early in June. However, the Dow Jones failed to do so and rebounded from 27,050. So if you are trading the lag between the Dow Jones and the S&P, maybe performance, you could rely on this previous stop. So this is for the Dow Jones. Let's also assess the WTI. We've been trading inside this consolidation zone for a while, and even if we just apply the ATR, we can see that the volatility is very low currently. It's been dropping towards almost $1 range a day, which is very low relative to the move since early December 2019. So the investors are awaiting like fresh fundamental driver, more clarity on the outlook in order to jump into their next trade. So let's just highlight some key levels. So on the upside, we could have some resistance near last week's highs near 42.55 and again near 44 level. And on the downside, we have to watch out for any break below the 40 psychological level, which could trigger further downside towards 38.60 and again towards 37. So these are the key levels if you are trading oil. Watch out for the pivot near almost 41, a minor support, the psychological level near 40. Again, support one near 38.60 and then support two near 36.90. And on the upside, we have to clear above 42.55 in order to move higher towards the 44 level or around 45. So these are the key levels if you are trading oil. Let's just have a clearer look. You can see that the deviation, the standard deviation or the Bollinger Bands, they are too narrow. The distance or the distance between the upper band and the lower band is very minimal. Maybe this is the lowest on record. You can see if we go back to the chart, you can see a place where the distance between the upper and the lower band was less than almost, currently we have almost around $2. So it's very thin, and this is just signaling that investors are waiting on the sidelines for fresh catalysts in order to jump into their next trade on oil. So this is all for now. If you have any questions, please write them down so we can answer them. I just need to remind you that all the information, analysis, opinions, and news mentioned in this webinar are only for educational purposes, and ICM doesn't provide any trading advice. Okay, so gold, yeah, okay, someone is asking, Mr. Ahmed is saying that uh, the price of gold seems a bit overvalued and artificial. So what we have to say on gold, especially that if we can go for, we can just have a look at this recent spike in prices. So if you just have a look at this recent rise from 1810 towards 1944, definitely it's not similar to the previous chart, the previous price moves in the chart. So it is definitely like a fresh money pumped into gold. Investors are pricing in some rally on the long run, or just trying to jump into trades where maybe based on some fundamental conditions, they believe that the market is mispricing, that the gold price is mispricing the fundamentals and it will reprice on the long run. So this is one of the key factors behind this sharp move. Definitely, we have a move of 130, almost $130 in less than 2 weeks. So this is something significant that there's a fresh pump on gold, but there are a couple of reasons that they are supporting this medium. Let's not forget first that the top central banks around the world, they have their interest rates near the zero level, if not negative, if not in negative zone. Top central banks around the world, they are also running their asset purchases program and also adding money supply in the market. So this is definitely is making gold more attractive. So investors are rushing to gold. Also, let's not forget that the current outbreak in China and the United States is uncontrollable, and it could affect the economic recovery, the expected economic recovery, and maybe could trigger further rounds of fiscal and monetary stimulus, either by the Federal Reserve or if not by the Federal Reserve at the current state, at least by the government. They will go for a fresh round of fiscal stimulus. So this is, see, these are among the key factors that they promote such massive moves in gold. And especially also we have the rising tensions between China and the United States and their implications on maybe also the economic recovery, the global economic recovery, since we witnessed back 2 years back that the trade tensions between these two currencies, these two countries, they had a serious impact on the global economy. And also the impact triggered maybe some further easing from the Federal Reserve, and also we've seen gold breaking back then above the 1370 key level and rallying towards 1550 back last year. So these key factors, they can support such massive moves. So and we have to get familiar with such moves, since we have almost zero interest rate medium around from top central banks around the world. There are a lot of money being dumped in the market, so definitely this would make gold attractive relative to what we've seen gold in the past couple of years. Exactly. On Wednesday, we have the Federal Reserve interest rate decision. We have also the presser by Jerome Powell. So, among the key risks for this price for this rally in gold could be any hints of tightening in monetary policy by the Federal Reserve, but definitely the Federal Reserve will not go for tightening in monetary policy before ensuring that the economy is back on track. And we can't ensure that the economy is back on track with the virus being spreading rapidly. So this is a very long run. On Wednesday, we are having a webinar about gold, about the history of gold trading, and then also we're going to talk about the risks for this rally and what is supporting this rally, and also we're going to have some look at the chart of gold. So also you can join us, sir, on Wednesday. So this is all. If you have any further questions, please write them down before we end today's session. Okay, perfect. I believe this is it for today. So stay tuned. On Wednesday, we have a webinar on gold, so you can join. This is all for now. Thank you all for joining.